Hello everyone, and welcome to my first video lecture. Let's see how this goes. Today we are going to talk about the end of chapter 10 and self-constructed assets. If you look at the slide presentation, it is slide 51 where we're starting on chapter 10. And it identifies two issues that are concerned with self-constructed assets. One deals with the indirect overhead costs and how we're going to allocate them, and the other deals with how we're going to capitalize the interest that was paid out for the construction of these assets. Um, the indirect costs and the manufacturing overhead, that is more of a cost accounting issue. As you know, we've been talking about overhead in our Accounting 350 class. So we will leave that for that class, and we were only going to deal with the interest capitalization, okay? So you move on to slide 53. It's going to talk about how this process is accomplished, okay? So step one, you have to determine if we have a qualifying asset. So a qualifying asset is anything that we are constructing for our own personal use, for the company's use, that's going to provide some kind of economic benefit, or it can be also some kind of construction and process that we intend to put into inventory and sell at some later period, okay? The second step is to determine the capitalization period. Capitalization period begins on the payment date for the most part, okay? It's when the first payment happens. But there's a little caveat in that construction also has to be started, okay? So as long as construction has begun, you always start capitalizing the interest on the first payment date. The only time that will be different is if there was a prepayment. So say maybe there was a payment made on January 1st, but construction didn't start till March 1st, okay? So then you cannot start capitalizing the interest on the amount paid in January until March 1st when construction begins, okay? And then the capitalization period is going to run and through until construction is complete, not the last payment, okay? Most of the time, the last payment is going to be made before construction is complete or at the construction completion date, okay? But it's important to remember that it ends there, not the end of the year. All right. So the third thing we have to do is find the weighted average of the expenditures, okay? And this ties back in with step number 2 because you have to know the capitalization period in order to find the weighted average of expenditures, because what you're going to do is you're going to take the expense, the amount that was actually paid, and then you're going to multiply it by the capitalization period, okay? There might be multiple payments throughout the period, so you have 3 or 4 of those, you take those, you add them together, and that becomes your weighted average. And the fourth step is you have to apply a percentage to these. What interest rate are we going to put to capitalize? Now, there's 2 ways to do this, as the book says, but it's really just one way kind of mixed together. So there is, first you apply specific loan interest. So if there was a loan taken out specifically for construction of this asset, you're going to apply that rate first. If there is not, you're going to use a weighted average of all outstanding debt. If there's a mixture of both, as you're going to see in our example, you apply the amount up to the construction loan, and then you apply that percent of the amount borrowed up to the expensed amount of the construction loan. Then any expenses above that amount will use the weighted average of the other two, okay? So maybe this will make more sense when we work through an example. We're going to work through the problem that is on slide 54, okay? So in this example, if you will pull it up and look at it, you will see that we are constructing a building for our own personal use. It's going to be a business headquarters. So step one is complete. That makes it a qualifying asset, okay? It tells us in the problem that construction is going to begin on January 1st of 2021, and that it was complete on June 30th of 2022. So that's the construction period. So then for the capitalization period, we look at when the first payment was made. The first payment was made on January 1st. Okay, so we can start our capitalization period at that point in time because construction has begun and a payment has been made. Both things have to have had occurred, and they have at this point in time. Okay, so now I'm going to put up on the screen and talk in the background how we would calculate the weighted average expenditures for this. If you notice, they made payments on January 1st, March 31st, and September 30th. Okay? The amount of payments that they made, right, on January 1st, you can see they made a $500,000 payment. It was out, we figured our capitalization period started at that point, and it's going to run to the end of construction. So in year one, we're only looking at 2021. Well, the capitalization period does not end till 2022. So the payment made on July 1st was being able to be capitalized for 12 out of 12 months. Okay. The payment on March 31st is only able to be capitalized for 9 out of 12 months. And coincide going down to the September 30th payment, only 3 out of 12. So we get a total of $950,000. Okay. That is the amount that we are going to be able to capitalize for interest. Okay, the interest paid on that $950,000 cost to construct that building. So when you go to capitalize interest, FASB states that you either get to capitalize the actual interest paid for the period or the implicit interest that is paid for the period. Okay, the implicit interest 99.999% of the time is always going to be smaller than the actual interest. Because when we look at actual interest, it is going to be the amount of actual interest that we have to pay each year on all debt that the company has. So this, in the problem from slide 54 again, it tells us that this company took out $1 million loan at 8% interest specifically for the construction of this building, but it also had a $2 million loan at 6% and a $4 million loan at 12%. Okay, so when you go through and you look at the actual interest here, the actual interest payments off of all of these, it's going to total $680,000. Okay, so if a question asks what is the actual interest for the period, $680,000. What is the implicit interest? Well, we figured up here that our weighted average of expenditures was $950,000. We take that 950, and that is what we are going to calculate our implicit interest off of. As I told you at the beginning, first thing we're going to look at what rate to use, was there any specific loans that the company took out, specifically for construction of this asset? Well, in this case, they took out $1 million loan at 8%. So the $1 million covers this whole $950,000 of expenses. As you see, we're going to have some in year two where it is not, but you will just apply that 8% and you will get $76,000 in the implicit rate. So you use whichever is smaller. That is the amount you get to capitalize. So when you go to make your journal entry for this, you're going to do a credit to cash for the actual amount paid. You will debit the asset for the amount of the implicit interest, and then the remaining amount will be debited to your interest expense. Okay, and that is how you will handle year one. In year two, there were a couple payments. There were payments on January 31st and April 30th. So the first thing we have to do here is go through and figure out our weighted average of expenditures again. Okay, but you have to remember that the project ended on June 30th. Okay, so that is when our capitalization period ends. So we are not going to the end of the year this time. Okay, so you're going to have to count the months that the payment was out up until June 30th. So that's why the payment made on January 31st is only 5 out of 6 months, because it was only out for February, March, April, May, and June. Okay, so 5 months. Pay on April 30th was only out 2 months, and there was only 6 months of capitalization period in this year. The weighted average expenditure of those come out to $600,000 for the period. Okay, our actual interest rate is going to be the same because we still have the same amount of loans out and we're still paying the same amount of interest. This time we have to calculate our implicit rate a little bit different. As I told you before, first thing you look at is asset-specific loans. We had $1 million, but we already took $950,000 out of that. Okay, so we only have $50,000 left that we can apply this 8% to, which comes to 4,000. So we are going to have 4,000 that we can capitalize that comes from this, but as you can see, the 600,000, that still leaves us 550,000. So what are we going to do with the remaining 550,000? Well, this is where we're going to find a weighted average of our other outstanding loan, and we're going to apply that percent to it. So how do we do that? We look at our other debt here, okay? We had other debt at 2 million at 6% and 4 million at 12%. You get your interest payments on them, and then you take the interest that you're going to pay divided by the total principal to get an interest rate for all your other outstanding debt, which comes up here at 10%, okay? Take that 10%, apply it to the remaining balance of expenditures that has not been taken off by the asset-specific loan, in this case is $550,000, gets us $55,000 at the 10% rate. You add it to the 4,000 above, and you come up with a $59,000 implicit interest rate amount for the period. Again, you capitalize the lower of the implicit or the actual, and the actual is the same as the previous year because our loans did not change. Okay, so we would capitalize an amount of 59,000 on this. So when we went to make our interest payment, 59,000 would go to the asset. The actual amount of interest that had to be paid would be credited as cash, and the remaining would become interest expense. Okay, it's not a real hard process. It's just remembering the steps and remembering what interest rate to use and how to determine the capitalization period. I will put a practice problem on Moodle that you can work through over the weekend, and we will go through it first thing in class on Monday morning. There's a few other topics that I need to touch on in chapter 10 before I sign off today. As you flip through the slides, you'll notice it talks an awful lot about research and development and how to classify research and development. What I want you to know is that research and development is always, always, always an expense under US GAAP, okay? When you're researching and developing a new product or a new service, it is not something, even though it's going to create an economic benefit in the future. So it would make sense from a theoretical standpoint that it would be something that you should capitalize, and then in turn when you sell the product or you are getting the benefit from it later, you would then get to expense it to kind of match for the matching principle, to match your revenues with expenses. But this is something GAAP has determined because when you're researching and developing, you're not certain that that product's ever going to hit the market. And that could run into a big problem when you have a bunch of research and development costs that you assume were going to provide an economic benefit, which in turn never do. So to alleviate that problem, that's why GAAP decided, in my opinion, to all research and development costs are now expensed. And the next thing, and the final thing I should say, are startup costs. When we talk about startup costs, those are considered organizational costs. Those are the legal fees that you might have to pay when you're going from being a sole proprietor to becoming incorporated, okay? To pay licensing fees to separate states in order to get your business name, or to get anything you need to get set up that is not directly related to your assets or your product. Because you remember getting an asset ready for use and all that stuff and all the startups, I would say, okay? When you're talking in your regular vernacular, you might say the startup cost of this asset. That actually gets put on the asset. But when you're talking about the organization as a whole, there is no big account that allows you to accumulate and capitalize those costs for starting your organization and then expense them throughout the life of the organization. Okay, that's just not allowed under GAAP. So all those, remember, startup costs are expensed. And the book and the slides go into software and oil companies. They have some very specific set of rules when it comes to their research and development. We're not going to go into great detail on them because they are very highly detailed and very complex. And if you end up working in that industry, you will definitely use the codification. It will become one of your best friends. Okay. I hope you enjoyed this. I hope this was helpful. I am hopeful in the future I will learn how to use all the bells and whistles, and maybe I'll have to upgrade my account so I can put the PowerPoint on with me up in the corner or something like that. But Look look for that handout on Moodle, and I will see you guys next week.